Hi, Assalamualaikum. My name is Muhammad Syamil Adib bin Muhammad Asri. Today, I will present to you about the topics from International Financial Management, which is impact of currency appreciation and depreciation on the trade deficit. So, first of all, currency appreciation and depreciation depends on increase and decrease in currency value. Most countries lack the resources to produce everything on their own, so they rely on foreign trade to buy what they lack and sell what they produce. A trade imbalance is when economies import more goods and services than it exports. However, exports are outpacing imports in the trade surplus. Next, we will continue on the currency fluctuation. So, the natural results of floating exchange rates, which are the norm for the majority of major economies, are currency fluctuation. Exchange rates are influenced by a variety of factors such as countries' economic performance, inflation expectations, interest rate differentials, and the capital flows. Most nations have their own currencies, which are exchanged for foreign currencies to pay for goods from other nations. When they say exports, they also cover foreign currency payment made into the local currency. Usually, minor daily differences have minimal impact on the trade imbalance. There are no serious repercussions. However, they might annoy a few businesses that will experience lower profits that day. However, larger long-term changes might alter the trade imbalance because they have an impact on import costs, the relative price of exports, and the local product of demand. The effects of currency appreciation. Currency appreciation tends to make import cheaper because the same amount of local currency can buy more foreign products. Local consumer might find better prices on the imported goods, so imports tend to increase. Because local goods are now worth more in foreign currencies, appreciation can also make domestic production less competitive on the global market. As a result, exports typically decline. The trade gap grows as more goods as more than exported. Next, the effects of currency depreciation. When the local currencies depreciates, imports become more expensive. So, locals often buy fewer imported goods. On the other hand, exported goods cost less to international buyers, so their demand tends to grow. Fewer imports and more export will reduce the trade deficit and could lead to a surplus. Currency devaluation can be used by countries to achieve economic policy. Having a weaker currency relative to the rest of the world can help boost exports, shrink trade deficits, and reduce the cost of interest payments on its outstanding government debts. So, this is an example situation of the currency depreciation. If a nation imports more than it exports, there will be less of demand for its currency, which will result in the lower pricing. Money depreciates or loses value in this instance. Let's say that candy bars are the only product on the South Africa imports more candy bars from the US than it exports. As a result, it needs to buy more dollars relative to the rand sold. South Africa's demand for dollars outstrips America's demand for rand. This means that the value of the rand falls. In these situations, we will assume that the rand might fall to 15 relative to the dollars. Now, for every $1 sold, an American gets 15 rand. To buy $1, a South African has to sell 15 rand. In a nutshell, to sum up, as the economy changes to produce the surpluses requires to pay back foreign investors, it is possible to assume that the trade deficit will eventually cause the dollar to weaken. However, In the near term, there is no correlation between the trade deficit and the value of the dollars, which is mostly based on investor preferences for assets denominated in dollars.